Anyway, so hello. It's another update in the market, just like every other day. So this is really crazy. Fortunately, we have plenty of longs, so I'm not too worried about it. But this is some insane action in the market. Oil took a big plunge, but it's recovering. And the dollar is, see, the dollar's creeping back up, but not a big deal. I mean, the dollar was way down, and now it's 103. It's almost 104. Got rejected. So we'll see what happens. But all the indexes are happy, and you can see it a lot better if we go to the big charts. So futures, as you can see, the dollar is on the whole very far down. So this can end up reversing the market if it moves down there. The indexes, look at the month of November. I mean, that's just freaking incredible. So huge gains. 4,100 to 4,600 is 400 is basically 10%. So you're looking at almost a 10% gain in the S&P. And the NASDAQ, 1,400 plus 10% would be 15.4, right? So that's a 10% gain in the NASDAQ. We blew past that. So these are some nutty gains. 4,000 to 4,400 in Europe. That's also a 10% gain. So we're looking at 10% gains popping up all over the place. The VIX has collapsed. Life is good. Everyone's happy. What could possibly go wrong? And I'd say I got no idea. Now, last week, the short-term portfolio was 67%, and we're going to have to sign back in, I think. Let's see what happens. So, obviously, well, the short-term portfolio certainly should have lost some money. No. Wow. Okay, so we got good balance. Not good balance. I mean, we're still a bit bullish in the short-term portfolio. So it's working out really well for us because the long-term portfolio is blasted up, 32% now. 32%, we had a $500,000 portfolio, so we got to be at 750, right? Ooh, 650. Oh, bad math, 650, 500 plus 150. So we're up 32%, 160,000 gain there, and we've made money in the short-term portfolio. So once again, we're at record highs. So we're not complaining about this rally, but it is, I complain fundamentally about the rally. So in other words, my attitude is that this rally is too much, too soon, undeserved. So just because we're making money on it, that just makes me kind of more skeptical about it and a little more concerned. But this rally is just non-stop right now. So that's up 30%. The butterfly's up 26%. The income portfolio is up 40%. And the money talk, so everything is coming up roses here. And the money talk portfolio is up 320%. So it's up 20% since I did the show a couple of weeks ago. And that's obviously we don't touch the money talk portfolio, so it is what it is. So basically, yeah, everything's just zooming along and everything's great and nobody has a problem. So that bothers me. I don't like it. I do not like it when everything is going so well. It just seems wrong. Sam Altman is organized. He's got his robot army behind him now, his AI army, and we're going to all see how that goes now that he has become more powerful than ever. That's a good thing of power. I like that. I love the wrinkly jacket touch too, from sitting in the chair. So we talked about the Fed today and what they're doing. And we talked about this is where I got, this is the problem I think. There was a Wall Street Journal article, American shoppers have plenty of dry powder. And this is what you would call the consensus, right? I mean, basically it's on the cover of the Wall Street Journal, or it was this morning. Oh, look, it disappeared. Huh. It was on the cover because I guess my critique took it off the cover. I took apart I took apart what it was doing. But anyway, it was like the second, it was like over here in this spot. But anyway, so where were we? Right, that. So the article is talking about, which is the general consensus, you'll hear it on CNBC and stuff too, that, oh, the consumers are great and everything's great, blah, blah, blah. But meanwhile, you get the consumer sentiment report and it's awful. And whoa, what was the consumer sentiment report? We forgot all about that. Oh, there's so much stuff going on. I forget to like check things sometimes. Let's see. That was this morning, right? November 30th. No, this is next week. This week. Consumer sentiment 61.3. So yeah, it bounced. When we expected it to bounce, and also oil prices have come down considerably from last month. So you figured that the consumers are a little bit happier this month, but you know, this is a terrible, terrible level. But yeah, we touched 60 last month and now we're coming back a little bit, but that's obviously you're going to bounce off 60 because 60 is effectively a depression. It's not reflected in this chart yet. This blue line right here, total, is what's testing 60. And look at where 60 is. I mean, 60 is COVID, and 60 is back in 2012 and the big crash of 2009. I mean, you should not be at this level in a healthy economy. A healthy economy is up in the hundreds, not freaking 60. This is really, really bad. Came in at 61.3 versus a reading of 60.4 and October's final reading 63. Oh, October's final reading 63.8. Oh dear. So we are still going down. So the final reading for October was raised and now we're at 61.3. November marks the fourth straight month that sentiment has declined. So this is not good. Current conditions. Okay, so here you go. So current conditions. So the overall sentiment is down. So we went from 71, 69, 67, 63. This is terrible. 61.3. The outlook is 68, 65, 65, 59, 56. Terrible. And the present conditions are also declining. This is a terrible report. This is not a market goes back to record highs kind of report. So something's wrong. All right, and that goes back to here. So this is, you know, this is where I think there's a problem because you've got the mainstream financial media is pushing this story that everything is fine, but the reality is not fine. Jesus Christ. I gotta cut this app. Is that? Why does it keep coming in like that? All right. So where was I? Oh, yeah. So the reality is I had a Shellbot, which is Bing, check the data. Because this is Claude reading the article and telling you what's in it. Okay, so Claude has no internet access. So he just tells you what's in the article. That happens to be, by the way, though, extremely useful because if I want to find out about something that's going on in the news or the media, I can just give Claude 5 articles from different places and have him synthesize, you know, what key points are in the 5 articles, and it gives me a better idea of like what's really happening instead of like, you know, from everyone's got their own opinion basically. It's very good for that. It's good for, I can give him annual reports and a couple of annual reports. I had him the other day, I gave him the 2 different Fed minutes and he just, you know, reads them and says what's different and what we should look at. It wasn't the other day, it was this morning. It was in this article at the top. Okay, so I gave Claude the 2 different Fed minutes, and he says, oh, and well, I asked him what was really changed that's significant. He says in September this, in November that, September this, November that. You know, he's great for that because unlike the other guys, he doesn't tend to make things up. He pretty much sticks to the source material. So I love Claude for that reason. Very, very smart, but doesn't have any web access. So he can't search the web. Now Shellbot, which is Bing, can search the web. So I said to him, I said, hey, I said to Bing, here's the article Claude looked at. Here's what Claude said. I'm skeptical about these statistics. So can you please verify all the data? So then he gets into a nice in-depth sort of thing, going to all this. And he said what I feel, but it's hard to, you know, it's better when you have the numbers to back it up. And basically, yeah, the consumers are at the end of their rope. And the problem is that, you know, you get this information from these people, you know, people in the Wall Street Journal, people in the financial media, they've all got high-paying jobs. They're not hurting. These people are in the top 10%. So when the people, and this is a problem with all the wealthy people taking over the media and so on and so forth, all the small papers, all the ones that can't afford to advertise, they can't compete and they get washed out. And there's less and less and less alternative media. And basically everything is, there's basically 6 companies that own almost everything. I think they own like 93% of all the media in America is owned by 6 companies that are all run by billionaires. And they're billionaires who employ people for hundreds of thousands of dollars and blah, blah, blah. And that's the opinion you get in the news. And no one has principles. The principles of most of these people are, I want to keep my job and keep my $200,000 salary or whatever. And you're not going to get unfiltered information. And so it's a bunch of people in the top 10% telling everybody how great everything is. But that is not the case. That is not what's really happening in this country. I mean, I went out yesterday and we had a salad, which we split, was $15 for the salad. I was paying attention for a change. I usually don't. The salad was $15. The drink of a glass of wine was $12. And this is a neighborhood little place. This isn't you know, some fancy place. I had, what did I have? Oh, I had a veal parmesan that was really good, but it was like 28 bucks. And it was great. It was great. I'd have it again. It came with some noodles, but I had to buy the vegetables for another $8. So we bought a plate of vegetables for $8. I mean, it's getting crazy already, right? And then and the girl I was with had what did she have? Fettuccine Alfredo. That was also very good, but also came with nothing. It was just fettuccine Alfredo with absolutely nothing, not even vegetables in it or anything like that. So we used the vegetables that we bought on the side. Anyway, so you're talking about, and that was 20 something dollars, like in the low 20s. So let's say 23. So the whole thing was like 80 something bucks. And a tip basically, so you're getting into $100 for 2 people to have a freaking dinner and not a fancy dinner. I mean, this is not normal. So basically, to put it in context, if I make $20 an hour and I work 8 hours, I'm going to make 160 bucks. I'm going to pay, and that's going to be, well, let's see, 40 is 800. That's 800 a week is 40. So if I'm making 40 something thousand dollars, you know, which frankly, just a few years ago used to be an okay salary for somebody to make. Not great, but it was, you know, the median household income was only like $60,000. So a normal person in the bottom 80% who's making a $40,000 salary probably has a partner who's making a similar amount. So they have $80,000 between them, but still, you know, you work for $20 an hour, you work 8 hours, you make 160 bucks. The government's going to take 50 of that back. So you're going to have $110. So your entire day of work pays for dinner. And the same is true if you go to a movie. A movie is $20 for a ticket and $20 to buy popcorn and soda to go with it. That's gotten insane too. It's not the ticket prices at the movies, it's the food of the movies. It's insane. And that's because that's where they make their money. They don't make their money on the tickets. They make their money selling the food because they have to give most of the money to the studio. And everything, and it's, you know, we were talking about that the other day. Sports tickets have gone way up. All sorts of things have gone to crazy extremes. So and even all the streaming services, they can't even sit home and watch TV because they keep raising the prices of all the streaming services. People are not, that's why people are not happy. This is why everybody's pissed off at Joe Biden. They're blaming Joe Biden. Like, you know, it's like, dude, you're the president and you're telling us how great the economy is, but meanwhile, it actually kind of sucks. You know, you can't just tell people how great the economy is, and the economy isn't great because the GDP is up 5%. That doesn't make the economy great if the people who are in it aren't participating. We're still way, way behind on the wage cycle, and that's because the Fed is purposely controlling things to make sure wages don't keep climbing. They don't want wages to keep rising. That's what kicks off an inflation cycle. So the Fed is working very hard to not let the economy get too hot so the wages start, you know, the workers have more pricing power. And because of that, then wages are not keeping up with inflation. People are falling behind. And there's the whole issue of shrinkflation, which means you get less stuff for more money. And that's not being accounted for either. You know, so inflation for real people, especially when you take into account things like rent, which is completely out of control for people who are renting, property taxes, which are not even counted as inflation, are out of control. You know, it's not good. People are being pressured from every which side. Health insurance, way more expensive. Any kind of loan you get, auto loans, the cost of the auto, the cost of the loan on the auto. You know, you used to be able to get a car, $300 a month used to be like a reasonable car. Now it's like $5, and the insurance is going up. Well, in Florida, you can't even get insurance. This is problematic, and that's what this data reflects here, is that this is a big problem, and consumers are going to break at some point, and it's not priced into the market because basically the people who you listen to, you know, when you go to anywhere, when you go to Bloomberg or you go to whatever, the Wall Street Journal, you know, pick a billionaire to give you your news, and they're going to tell you how great everything is. And that's definitely going to be an issue. So that's probably my single biggest worry is that. My second biggest worry is that the only reason that real estate hasn't completely collapsed is because China is propping up, you know, $1 trillion worth of loans that are effectively bad loans. And you know, the good news is you can prop up $1 trillion of loans because you only have to pay the interest on the loans to prop them up. They don't turn bad until somebody defaults. So if you don't let anybody default, you know, and if it's let's see, it's $1 trillion, that's 1,000,000, 1,000,000,000, $1 trillion times 0.05% interest is $50 billion. It only costs you $50 billion a year to prevent $1 trillion in loans from defaulting. So what's China going to do? They're going to make sure that the $1 trillion in loans don't default. Way better to spend $50 billion a year than to let $1 trillion of loans default, because that'll take the whole banking sector down, and you'll be making a lot more than $50 billion worth of emergency loans and bailouts and stuff. We just spent $2 trillion. We just spent $2 trillion in March to bail out our banks. The government threw money at the problem and pushed the whole thing off. So that was our contribution. China is doing their part also to make sure things don't default. But to do that, the governments go further and further and deeper into debt, and our debt is completely out of control. Our interest on the debt went from $300 billion a year, which really was nothing on $33 trillion worth of debt. So our interest on debt went from 1% to now it's 2%. But as we keep rolling over our bonds, we're going to be at 3% and then 4%. And 4% is going to mean we're paying $1.5 trillion of interest payments to maintain the debt that we already have. And while we're doing that, we'll be going another 1.5 trillion a year into further debt. It's not sustainable. It is not going to end well. But the market is at, moving back towards record highs, and people, several people like S&P Global or whoever have raised their forecasts and are predicting S&P 5,000 for next year. They're predicting another 10% increase in the S&P 500 for next year. So basically, nothing is going wrong now. Nothing's going to go wrong in the future. Everything is great. That's the market premise that everybody's operating under. I'm very worried about that. That's the crux of it. I'm extremely concerned. I think that and I think things are going to go badly. All right, let's put it that way. I'm very worried about what's going to happen. Anyway, so moving off of that, let's talk about what great stocks we can play. So yesterday, if I can get there, it's a long article today. So yesterday we have we're looking at our top trades. And there's still work to be done. It's not gonna, I don't think I'm gonna get it. Believe me, I'm not killing myself this weekend to get it done. So it'll take a while. But so last year, our top trade finalists last year. So I think it wasn't, I don't think I got done till the end of the month last year, right? So yeah, November 30th last year when we finished our trade of the year. So don't get excited on the 22nd that I'm not done. So last year in the 2023 trade of the year, first of all, I talked about we needed to hedge. And boy, did we, because the market really tanked in the first quarter. And that was the problem. I was sure the market was going to tank, and it did in the first quarter, but then we recovered, of course. So I talked about the hedges before we started anything else. But Apple, these are live updated charts, and not the charts at the time. So Apple, we talked about a trade. We talked about Comcast as a trade. All of these ended up working out. Google as a trade. Google, of course, did fantastically. Jackson did the best. Jackson doubled. Simon Property Group, we had a trade on that one, and Yeti ended up being our actual trade of the year. And it didn't, I mean, it was pretty down. It was like 35 somewhere down here back in November, and it got to 42, and our target is 50 for next year. So we're right on track, but because the trade started as a $250 credit, it was a no-brainer. Now it's like a $9,000 spread. So huge profits there. Anyway, that was last year's trade. So I talked about those a little bit here. And so this year, here's our contenders. One second. So we're looking at Crocs. And let's talk about why we like them. I like Crocs because they're inexpensive shoes. People always need shoes. There are more and more people wearing casual shoes because you don't have to buy as many work shoes now because less people are having to go to work every day. So that's a good thing too. Of course, if you're sitting around the house all day, you don't necessarily have shoes on at all. So 50-50, but still the demand is there, shoes wear out. And and I like them as a steady stock. You know, the disposable consumable items. That's what they are basically. Best Buy. And again, I think they also benefit from the work at home trade. I think more people buying better stuff for their homes and better computers. And obviously they got TVs and appliances too and all sorts of things. BioNTech, we decided was too risky because it's a question of, I don't know if there's going to be a catalyst next year. And because they did make so much money from the COVID drugs, all the comparisons are bad. You know, because there's much less vaccines going on for COVID. So that means they can't possibly match what they've been doing. But long term, I mean, it's a no-brainer. I think this one for the long term. Apple also, we just had this conversation in chat because Wingwalker has a position. I said, look, I don't think, right here is $3 trillion for Apple. They've been here before. They were at $3 trillion back in July, but they crashed. Not crashed, but you know, they had a correction, 15% basically. It's high. 3 trillion is high. It's basically 30 times earnings. It's a little too much. And PE 28.7. So a little much. But the price earnings growth ratio, the PEG ratio, is phenomenal. 4.1 is a phenomenal number. So that makes up for their high PE ratio. It's like, yeah, well, they have a high PE, but to give them a couple of years and they'll be justifying. Give them a couple of years, they'll be making $150 billion and it's going to be 20x. I mean, this is an insanely prize. This is the greatest company on earth by far. But that doesn't make him a trade of the year because I don't know. It's hard to say what's going to happen with China and the iPhone market there. And it's hard to say what's going to happen with their other products and so on and so forth and how much money they're spending on R&D. And 3 trillion and 30 times earnings is a lot of money to pay, even for Apple. They used to trade at 12 to 15 times earnings the most. So I mean, a lot of the doubling of Apple stock in the last few years is a doubling of how many times earnings you're paying for the stock. Allstate, we cut Allstate. Anything you see in red means we cut it. Allstate we cut because we aren't sure. You know, mostly because they already went up. I mean, we picked Allstate back in September. We added them and their Prudential to our long-term portfolio because it was so stupidly cheap down here, like below 110. But now it's 135. So basically, because they've already had a nice run, but so many things are going in their favor. You hear about these insurance companies pulling out of Florida and California. That's allowing the people who are still servicing them to raise their rates, and it's also allowing companies to fold unprofitable portfolios in certain states. So that's smart. And so that's so less losses, better returns on their rates. And also insurance companies have to invest their money very, very conservatively. So they have all these incredible amounts of insurance reserves that they can't really gamble with. And so they buy a lot of bonds. And so if bonds are paying well, the insurance company makes a lot more money. So that works out for them. Paramount, you know, their content. I mean, content is everything. Every day, all you do is look at the TV and complain about where's my content, right? So people who have content to sell are in the driver's seat, and they've got a huge content library. They're a good studio, solid production, films, TV. It's an overall good company to be investing in. They have great cash flow. It's just stupidly cheap. Yeah, as I said, I'm pretty sure I'm pretty sure they'll be in the final 5 is what I said about them. Then we've got Annaly Capital. They were just a top trade alert in September. Love these guys. The CIM, they're the same management team. 6.5 times earnings. But the earnings are not growing. But earnings don't really grow for a REIT. That's the thing. You have to understand that also. Because if it's a REIT, that means they have to distribute 90% of their profits back to the investors. How are you going to grow if you keep distributing 90% of your profits back and don't reinvest? So that's always a trick with managing a REIT. Moderna, they're losing money. They're losing billions of dollars right now, but it's R&D. They're trying to cure cancer, and they took all the windfall money they made from the COVID vaccines, and they're putting it into trying to work on a cancer vaccine now. And and they also have a vaccine for malaria that's looking very good. Curing malaria is better than a COVID shot. Malaria kills huge amounts of people each year. I don't want to say the number, but it's got to be over 1 million people a year are dying of malaria. It's a very serious thing, and it would be gigantic for them to have a malaria vaccine. So, but again, you can't count on that. It's just like any biotech, right? You can't count on them actually doing what they say they're going to do. Levi's, same reason I like Crocs, stupidly undervalued, 12 times earnings, all American company. This is the kind of play where I'd say it's not going to go down. So we might play them just to be over 15 and construct a play that's going to pay us really well if they're just over 15. MP Materials is a rare earth company. So, for magnets and electronics and so on and so forth, you need rare earths. Almost all rare earth comes out of China. And here's an American company that's doing it. The only problem with that is, the only thing that might keep them off the list is off our final 5 list, is they're in California where they're mining, and I worry about a change in law, because California could change their environmental regulations, say you guys can't do this stuff anymore. You're really messing up the environment. I mean, that's why China does all the rare earths, because they don't care if they mess up the environment, but California might decide they care. Now, MP, though, is doing it in a much cleaner fashion than China does, but then that makes them less competitive for cost. But because they're in the US, supplying the US, they're still getting all the contracts to sell pretty much everything they can make. So, on the negative side, they have a higher cost of production than China, but China's got to ship it over here, and people would rather buy from an American company anyway, especially government. So these guys are going to be all set. It's a great business, too cheap at $15. Tupperware. If they didn't have $450 million in debt, they'd be phenomenal. It's $80 million for the whole company. They're trading at 2 times earnings. It's just for the brand name alone, I would pay $100-200 million just for the brand name, and they've got patents and so on and so forth as well. But the world has changed, and I'm sure you go to the grocery store now, and there's like 10 different things that are not Tupperware that look like Tupperware. So it's a little tricky for them, but I still think I think there's something there. It's just it's the $450 million debt that keeps me off it. Vail, and I'm sorry, by the way, these things are in the top 20 because they're all freaking great. But are they the greatest of the great? That's where the questions are here. But they're all great values, all these stocks. Vail, another miner, also phenomenal, 6.5 times earnings, good growth. Just they're a strong contender. I mean, we just picked them as a top trade also. I said almost certain to make the top 5, so there you go. Restoration Hardware. Now, the only reason they're not going to make the top 5 is because they're $268 a share, and so it's not really accessible for the average person. And it's not, it's a tricky stock to add to your portfolio. I can't sell puts because I don't want, you don't want to be obligated to own 1,000 shares for $269,000. We don't have portfolios like that right now, so nothing that big. Phenomenal stock though, phenomenal company. They spent a lot of money changing themselves. They were Restoration Hardware, now they call themselves RH Incorporated or whatever their name is. And now they're kind of they're like the sharper image now for rich folks. They're like all the best of everything. It's not they sell luxury jets, things like that. They don't just sell hardware because they had such great brand recognition. There's nowhere else to go. There really is. There's not that many places to go to get the kind of stuff they sell for rich people's homes. And there are a lot of rich people in the world. You know how many rich people there are? There's 8 billion people. 8 billion people, and the top 1%, so we divide that by 99, that's still 80 million people in the top 1%. And obviously it's 8 million people. If you say the top 1/10 of 1%, the ridiculous, top 1/10 of 1%, they're earning at least earning $500,000 a year. That's their income. To be in the 1/10 of 1%, to be in the top 1%, your income is generally at least $200,000. To be in the 1/10 of 1%, it's closer to $1 million than 500,000, I think, at this point. But so you're talking about people who have $1 million homes and spare no expense whatsoever. And there's, again, 80 million people who make a couple of $100,000 a year and generally can afford $1 million home, but they're not necessarily going to say, I don't care what anything costs to do my kitchen. Whereas, these people, right? I mean, there are people who say, I want what I want. Like, I have a friend of mine who was having a boat built, and he had to have this certain Italian marble, and he had to have this certain kind of finish on the upholstery, and he had to have this and that, and he's ordering all this special stuff, and the boat takes like 3 years, but it mostly takes 3 years because he's got to have all this crap that's customized. And I'm like, dude, why don't you just like get some regular stuff? And he's like, he's like, I'm not gonna spend all his money. I mean, I understand the point. You're not gonna spend all his money on a boat and then skimp on the finishings, right? He's only buying this one boat. It's a big deal to him, even though he's incredibly wealthy. He's buying the boat and he wants to have exactly what he always dreams of having. He wants everything the way he wants it. I did that with a shower. In my old house, I had a shower. And when I moved in, I knew I was going to be in the house for at least 10 years. So I'm like, okay. I had a guy do my bathroom, and I had him do it with slate. I guess it's called slate. I don't know. It's a rough black rock, and I had my whole shower done in that because it's no slip. I like that. It's like it's a kind of material where the water, in no way, shape, or form, you're going to slip in the shower. So I like that. I thought that was great. Plus, I thought it looked cool. And so I had my whole shower with like slate walls and slate floor and black, and it had little alcoves and things like that for putting things. It was very cool. And and it was expensive, but it was like something important. But anyway, so rich people, though, super rich people, way richer than me, they've got they'll just spend whatever. And Restoration Hardware is a candy store for those kind of people. See if we can find that. So there's certainly enough of those people. Why can't you just find their website? Oh, here it is, RH.com. Look, sofas. But they've got the name, and that's the thing. So for the last, for 10 years or so, or however long they've been doing it, they've got this name. Wow, look how cool that is. See, gorgeous. They've developed a customer base, and their customer base said, well, you guys have good taste. What else do you have? So this is the kind, this is what I'm talking about. It's like, Byron, Italian travertine, Gale, American walnut. This is exactly what I'm talking about. Like my friend with the boat, it's like, I don't even know what the hell he's talking about, but it's like this, Italian Carrara marble. It's like, I don't know. To me, marble is marble. And what kind of oak, and where is this from, and what endangered thing are you killing to get this? It's nice stuff, right? But this is what Restoration Hardware is now. That's why they're called RH now. They don't want to. They're effectively off the hardware thing entirely. There's no hardware featured in their catalog. Look, beach house, ski house. Oh, I love ski houses. Let's see, baby and child section. Anyway, this is what they've done with all their money for the last however many years. What is it? Oh, I don't get it. A gem in the Rockies. Are they selling real estate? I don't even understand what they're doing. Oh, I see. Okay, no, they're selling it. They're selling all the stuff that goes in the house. Oh, geez. Look at this. I like that. The chandelier made out of antlers. Everything's made out of antlers. That's a bit much. Ooh, I like the fire pit. Anyway, so you get the idea. So it's very, very, very expensive stuff, but I love the company. I think that so they spent all this money to have build all this catalog of things and get the inventory, and they searched the world and found the best of the best of the best, and now they're starting to sell it. And the timing was terrible because they did all this during COVID and people weren't buying anything and weren't decorating houses and so on and so forth. But now we'll get back to normal and this should do very well. I think we can get a little for the long-term portfolio. You just got to be very careful with it. Synchrony Financial. They're not much of a bank, but they're very big on the credit cards and things like that. So I like that. And they're stupidly cheap, 6 times earnings, not even 6 times earnings. Incredible growth at 4.1. They grow like Apple. They're priced like they're going out of business, and they seem to be a pretty damn good bank. So that's possible finalist also. It's just very tough to get away from them. Trox, we just added to the long-term portfolio. They make very special titanium dioxide. They make it in America. And again, it's a local supply. It's high demand. It's a critical element in a lot of production. So I like them for that. The Disney company. I would have gone with the Disney company in the top 5, but they just put out a movie called Marvels, which was $400 million, and it only made $100 million in the first couple of weeks. That's a catastrophe. That is a catastrophic failure of film. So it's just not the right time to jump into Disney. Also, they closed the Star Wars thing. They're going to take a loss on that at the theme park. That was a disaster also after they spent all that money. Not the whole theme park part of Star Wars, but the hotel and everything they gave up on it just wasn't working. And that was like a $1 billion mistake. Ares Capital, also very interesting. Good little company, business development loans. I'm a little concerned, probably won't make the top 5 because I'm a little concerned about the business loans that they put out going sour if things turn down. So that's a problem. Corning, they make the glass for the iPhones and the iPads and lots of other phones, and this is a good cycle for them. So it's a good time to buy this company. Very likely to make the top 5. I must have 10 guys who are likely to make the top 5, right? Dick's Sporting Goods, a little high in the channel, so they're not going to make it, but that's the only reason. Very good one. And Future Fuel. Oh, sorry, excuse me. I'll be right back. All right, sorry about that. So Future Fuel, where are we? They make like biofuels and things like that. but they're working on a lot of cool stuff. They make a lot of money. They people misunderstand them because their accounting is a little weird, and it sort of downplays how much money they're really making. But if you look at their cash flow, it's excellent. So I love them down here. I'm not. I don't know if I have a reason not to buy them, frankly. So I think that's going to be a finalist also. Now, so when push comes to shove, though, what we're going to do is the next thing we're going to do. Oh, I'm sorry. Well, we actually already did it. So what we did is we have some analysis here of each company, and we talk about why they stand out for the trade of the year. Now, caveats to consider, blah, blah, blah. So I'm going to dig deeper. So now the next stage is we're going to dig deeper into each of these things and say, what can mess this thing up? Why, why will it not, what would not work about this? And that's what we're going to do. So we're going to look for things that are bulletproof, but you've got to try to tear apart your own premise and sort of say to yourself, well, what could go wrong with NLY? What's our expectations? What's our trends? And that's important too. We have to think about what are the trends for 2024 that are going to be big in the market, and then we have to decide whether those, where our stocks fit in with those trends. What's going to be important, what's going to work, and what's not going to work, and so on and so forth. So there will be further analysis needed, and we will dig much deeper into that over the coming week. And we'll cut it down to 5. All 5 of the final 5 we're going to have trades on, of course. But then we'll finally end up picking one stock that's going to be our trade of the year for next year. And we have never failed. It's a lot of pressure. This is like being Lou Gehrig, and you got to get every day you get a hit. We got a 56 consecutive game hitting streak, and it's weird. It's like every time you get a hit, the pressure builds for the next one. Now you got 4 or 5 times at bat, and if you don't get a hit, you blow your streak. It's really tough. So the pressure just mounts and mounts and mounts on these ones. What else? Yeah, so basically, and then you got to, we're going to have to dig into each of these things and figure out what's going to be what. But I'm not going to do it now because it's going to take a long time. It's a lot of work. But that's where we are so far. I'll see if anybody has a question. Nobody has a question. Okay, fantastic. And that brings us back to the market. Where are we? Nope, things are chugging along here. So let's take a look at our charts and see how they stand. Yeah, you can see the NASDAQ has broken out. 15,000 was, this is what we considered the fair value for the NASDAQ. Now, NVIDIA just knocked it out of the park yesterday. They had crazy earnings. Where's Mr. Bing? Are any of these things Bing? Is that? Edge, yeah. Your browser has been updated to the newest version. Okay. Copilot. Let Copilot do the work for you. All right. All right, good. Go do my work. Dream it, type it, and see it. Boost your creativity. Okay. Create a QR code for any web page in seconds. Wow, I wonder what that's interesting. Edge and Bing make it easy to search. Read more comfortably. Save money with coupons. This is some good stuff, actually. You're 3 steps away from getting it. Oh, wait. What do you mean I'm 3 steps away? Why aren't I right there? Microsoft Start. Oh, I'm confused. Generate a page summary. I'm thinking of making career change. Watch recent talk. Anyway, I wonder if you can do that right here. Draw a picture of a zebra playing lead violin at Radio City Music. Oops. Oh, yeah, he's going to do it. See? So they've integrated the imaging into the thing. Takes a while, though. Oh, there you go. Oh, look at that. That's not bad. Good job. Wow. I wouldn't go with that choice. That's very nice. I like that one. So he has, I guess he has to have hands, right? He can't have a little hoof. Yeah, I guess. Kind of looks like a guy in a zebra suit, that one. Anyway, still has problems with the with words, unfortunately. There's an issue where they can't get the words right, but it's not bad. I mean, I can't complain. That one's good, but see the extra I, that happens a lot. It doubles letters. That's funny as hell. Anyway, why did I want to go here? I forgot now. Something more important. I got distracted by this thing. And how do I close this? How do I make this go away? I don't know how to make that go away. Oh, there we go. Okay. Oh no, don't do it again. Oh, we're on to a new thing. Okay. Can you make the zebra wear a hat? What about adding some audience in the picture? Make it, wow. Oh boy, I can't wait to play with this. So you can follow up. I wonder how well you can follow up on the picture you've already drawn. They give you the impression sometimes that they're doing something better than they are. But anyway, so I like I use it all the time. Here's Sam Altman's firing from the AI from OpenAI. What is the story of Sam Altman getting fired from OpenAI? Do we really know what actually happened? I don't know what day that was, but boom, boom, boom. So he tells me what's going on, gives me the link so I can check myself and follow up. See, that's from Wired, which is useful. That's from MSN. That's from Slate. That's from Wired again. That's from, I don't even know. Oh, that's from CNN. Okay. So anyway, so it's really good when you want to find something out or check something out. And so in this case, we're going to, what I'm going to be doing is we're going to be asking questions and finding out what the prospects are for something, what industry trends are like. So I'm researching future fuel FF, and I'm wondering how solid their forward projections are for 2024, given our expectations for next year, and what significant accomplishments the company has made in 2023 and plans for 2024 and the likelihood of success. Yeah, I know who they are. Okay, their forward projections for 2024 based on several assumptions and expectations. Demand of biofuels will increase. The price of crude oil and natural gas will remain high. See, there's a big risk that I wasn't even thinking of, that they're not going to be competitive if oil and gas are cheaper. The regulatory environment will be favorable for biofuels. So in other words, if it looks like Trump's getting elected next year, this might not be good for them because some of the subsidies might go away. Innovation and research capabilities of future fuel will enable it to develop and improve products. On the latest quarterly report, they made significant accomplishments, increasing capacity by 20%, launching a new product line, securing a long-term contract with a major airline to supply jet fuel from waste and oil fats, acquiring a specialty chemical company, Chemix, which specializes in custom synthesis and formulation of niche products. In 2024, investing in new technologies and equipment enhanced. And of course, you got to, you know, all these things are, these are now the links that you follow. So you want to make sure that they're accurate. That's another thing. You can't always trust it not to be making up stuff. But still, these are all good things to explore now that we can check out more on Future Fuel. Exploring new sources of feedstock for the biofuel. Okay, so look, is this important? They're investing in new technologies. No shit. They're exploring new uses for biofuel. Yeah, no shit. That's it. You know, it's kind of their job. Developing new applications for bioproducts such as, and again, no, that's not exciting. Pursuing strategic partnerships. Yeah, in general, that's what you always want to do. These are not great. Okay, these plans are not very solid. I don't like that. The likelihood of success, the volatility and uncertainty of the global energy and chemicals market, which could affect supply and demand, as well as prices and margins, the competition and innovation. Based on the information available, they seem to have solid, ambitious vision for 2024. See, now, that's the thing. These guys, they don't do what I do. Now, I'm looking at the 2024 plans and saying, yeah, well, yeah, any idiot would write this if you want to. If you have nothing to say, you'd say this about your company. I don't have any specific plan, but we're going to keep looking for new opportunities. That's not good for me. He reads that, and this is what you have to worry about with your AIs. He reads that and says they seem to have some really good ambitions for 2024. No, they don't. They have the same ambition any company has. They want to expand. They want to find more ways to sell their stuff and make better partnerships. That's just generally how you run a business. They'll need to monitor and adapt to changing markets, well, leverage strengths and opportunities. Okay. What? Given the macro environment, regulations, stimulus, and the upcoming elections, what would you say could cause a failure for FF in 2024? Okay, so you know what we're looking for is a bulletproof stock, okay? And if you get a lot of bad stuff, it's not necessarily going to be a bulletproof stock, right? So the decline demand for biofuels due to changing preferences, electric vehicles become more affordable or widespread. That's not good for Future Fuel because they're giving you a fuel alternative. They're giving you petroleum alternatives. So yeah, that's a problem, but it's not a 2024 problem. It's a longer term problem. It's not like, you know, there's still a big place for alternative fuels for now. Because don't forget, they already have the jets, they already have the ships, they already have the engines. They don't want to necessarily replace them, even if they could. They'd rather find a fuel that pollutes less. A disruption in the supply of feedstocks for biofuels due to the environmental, social, political. For example, if droughts, pests, disease affect crops or biofuels, wars or sanctions limit the availability of feedstocks. That's an interesting take too. See, that's not something I would have really thought about much. How likely is that to happen? Not very likely, but if it's something to consider. A lack of compliance or enforcement of the regulatory standards. So, that's interesting too. There may be standards and regulations that are forcing people to do it, but for example, if the EPA fails to set or implement renewable fuel standard volumes, or the states and ports challenge or overturn the program. That's interesting, right? So in other words, their future is based on the fact that cruise airlines and cruise lines in particular, and eventually all trucking and shipping, is going to fall under these standards where they have to really minimize their output of carbon dioxide, and so. But the time frames are unrealistic. So in other words, all cruise ships, in fact, let's check that. A failure to innovate complete biofuel specialty chemicals market. Well, okay, that's fine. I understand airlines and cruise lines will need to offset their carbon output next year. What's up with that? Okay, so they want to cap emissions from international flights at 85% of 2019 levels, and it phases in, right? Okay, that's what. So the pilot phase from 21 to 24, the first phase from 2024. Okay, that's what I care about. Only flights and cruises between countries that volunteer to participate are subject to the offsetting requirements. Due to COVID, huge decline. They proposed to use 2020 as a baseline year instead, which would lower the offsetting obligations. So in other words, they're pushing it back, and it's not realistic that they're going to be able to hit this standard. They made these agreements in 2019. Then there was COVID. Cruise lines lost tons of money. Airlines lost tons of money, and everybody's sort of like excusing that and saying, well, they couldn't make these innovations. They barely kept alive, and now's a bad time. It's barely getting back on their feet to start taking on these costs. So, yeah, that's a big point. So this is the kind of research you have to do to decide whether future fuel is a good stock. You see, and this is the kind of thing you have to follow. This is all this kind of research I'm doing all day long. Thank God for these AIs, because they point you in the right direction, and they're a lot faster than I just read 500 articles about future fuels on my own. Because the nice thing about it is it's especially with the linking, is it takes you off in different directions than I would have gone. So in other words, IATA course, I can learn about that. Save on cruises is not really important. Oh, I see. It's an ad with the link. That's what they're doing. See, freaking Microsoft, right? They got to figure out how to make money on this stuff. Booming airline traffic, of course, carries by carbon offsets. This is a huge thing that's happening. Of course, there again, that's the same article. Crushed by COVID, airlines lobby for a break on their emission offsets. Basically, so I've been keeping up on this. I do know what's happening, but you can see how it can lead you down different paths that are relevant that you would not have thought of when you were just reading about future fuel. Now I'm starting. So now, because I care about future fuel, I have to start caring about how exactly the offsets are working that run the business. Otherwise, I don't really understand the business, do I? People are being driven. The reason they've got a huge partnership with the airlines right now to supply environmentally friendly fuels is because the airlines either have to have more environmentally friendly fuels, or they're going to have to buy carbon credits to offset on the open market, and so they're going to spend money one way or another. So it's all fascinating, but I wanted to just give you an idea how the research goes. So, I could spend a day just checking out one stock, hopefully not. But I mean, it's, when there's a complicated story like this, I have to go all over the place and try to figure out whether or not this is going to be enough to bump them out of the top 5. Probably, there's a little too much uncertainty for future fuel to probably make the top 1. And by the way, if I once I decide there's no way it can be in the top, there's no way it can win. When I decide there's no way it can win, so in other words, this amount of uncertainty and the fact that Future Fuel is a very small company and can get derailed or things can get knocked back, I absolutely love them as a long-term play. We already have them in our portfolios, but are they stable and safe? And do they have a catalyst coming up in the next 12 to 14 months? By the end of next year, are they going to be a solid enough bet where I am positive I can make money on it? Then I have to go to answer that. Well, I tell you what, here's another fun trick I've taught Shellbot. Can you please give me your best possible valuation on FF for the end of 2024 and why? See, there's a huge amount of training you have to do to get into this position, but once you get it, he's very good at doing these things. But you also the words, because if you ask him to give a valuation, he's going to say, I can't give valuations. I have no idea what I'm doing. But if I tell him, can you give me your best possible valuation, he's willing to answer the question. He's even saying here, it's like, it's not professional financial advice. So he's telling me he's going to use a discounted cash flow model and the free cash flow. This is important because their free cash flow is what makes the company. But then, like I said, you have to check every single thing he says to make sure it's accurate. He could be looking at the wrong year. This is why I call him Shellbot, though, because he can't just give an answer. He has to like give you the entire story in excruciating details. But when you're checking his work, it's good that he does it. So he's looking at 18. That's substantially higher than it is right now. So why is it being undervalued? The market is underestimating the growth potential and profitability, especially in biofuel-based segment, which could benefit from increasing demand of renewable sustainable. The market is overestimating the risks and uncertainties. The market is discounting the innovation and research capabilities of future fuel. And then there are facts. So he's going back over that. Okay, great. So basically, yeah, he's saying it's certainly worth more than it is. That's the reason I picked him in the first place, is because I think they're being undervalued by the market. when you renew during our Black Friday sale, that's weird. But I don't understand that. Anyway, where was I? All right, so there. So we'll, oh yes, I'm sorry, options. So then the next thing I would do at that point, so I say, okay, so future fuel. Oh, and gold's up over 2,000, not Barrett gold, but Barrett gold is way too cheap because gold's over 4,000. So future fuel. Oh, I forgot about that. They only have short-term options. Damn it. See, they can't be the trade of the year because they don't have short-term options. I forgot all about that. Damn it, damn it, damn it. Oh, that's so annoying. Okay, so this cannot be the trade of the year based on the simple fact that they only have short-term options. But the stock is at 612. You can buy the $5 calls for $1.35. So that would be 635. You're only paying 20 cents premium, 22.5 cents premium to have the stock for 177 days, for 6 months basically. So that's net. Yeah, I would do that. So this is a good deal. It's if you do this spread, let's see, it's that'd be like 375 minus 135 is 340. 240. That's not worth it at all. Wow. There's no premium there. That's very interesting. So this thing, if you did the spread of the 255, right? It's net 250. There's no point to that spread at all. And this spread I wouldn't do because why sell the 750 puts? I'd rather take the risk. So I like just buying these naked calls right here. I think that's a good bet. You could also buy these and sell the 750 short calls for $1.60 or $1.55. $1.55 means you're netting in for $6.95, $5.95. You're netting in for $5.95, which is basically the current cost, but it means these are going to gain 100% of all the upside that you get from here, while these are going to make also. So, you're basically paying for these you're paying for these by selling these. And your bet is future fuel is going to be up closer to 750 by then. You can make a nice return on this thing, but can't be our trade of the year because unfortunately, we don't have a year of options to even give. I forgot all about that, and they are not going to make the final cut. That's a shame. So fantastic stock. How else could we run this stock? There's not a good way, really. Let's see. What if, let me do the math here. So what if we buy the stock for $6.12 and we sell the $1.40 $5 calls? That brings us down to $4.72. And we sell the 750 calls for $1.55. So now we're at net 317. So if we get called away at 5, we've got a profit of almost $2, but we would owe on the 750 puts. But we're at 6, so you have to keep that in mind. Now, if we're forced to buy more at 750 plus 750 divided by 2, so that's our risk. So in other words, if we buy the stock for $6.15 and we sell the $5 calls, which are in the money, for $1.35, and we sell the 750 puts for $1.55, okay, then our net is like $3, and we're going to make 40% on the longs at 5, and we're going to make the rest of the money and the rest of the money is 750, and we can roll the 750s along as more contracts come out. And our worst case scenario is, well, our worst case scenario is that, yeah, we would get forced to buy more. We double down at 750, and our average cost of the stock is 533, which is whatever it is, 15% below the current price. So we can do that spread. We can make almost a double on the stock getting called. No, I'm sorry, not a double. We're going to make 66% if the stock is called away in 6 months. We're going to make 10% a month if we get called away and the stock goes over 750. And even if we don't get called away, or if we get assigned, our net assignment is going to be 533. And that's perfectly fine with us. Because don't forget, that's in 6 months, we're getting a 15% discount. So then we do it again next 6 months, get another 15% discount, do it again, get another 15% discount. That means in 18 months, we're knocking 45% off the current price. And if we're ever right, we're going to be in great shape. But even if future fuel declines, we're still going to be keeping up with a pretty steep decline. It's for, like I said, 45% in 18 months, it can go down and we'll still be okay. So that's a good way to play it. That'll be an interesting way to play it, maybe in the income portfolio. If we don't already have it, I think we might already have it in the income portfolio. Where was that? Income portfolio. Future fuel. Nope, don't have it. All right, that could be fun. Let's consider that. All right, anyway, so not much else to say. It's a holiday. We're going to wrap it up unless anybody has a question. I don't think anybody has a question. Nobody has a question. Okay, fantastic. Yeah, I'm going to cut it short now so I can get ready to wrap things up over at in the member chat. Thanks everybody for coming, and I will see you after the holidays. Have the best happy Thanksgiving. Enjoy your families, and I'll see you again next week. All right, take care, everybody.